Borrow from your 401k? Have you gone crazy this time, Josh? I can hear that all throughout the financial planning arena when I tell you that yes, indeed, you should borrow from your 401k if you have debt to pay down. Absolutely. And I'm going to share with you why that is today. Welcome to another video of the Heritage Wealth Planning YouTube channel. I hope that you find this informative, and I certainly hope that this topic we talked about here today gives you something to think about that you might have not thought about before. We're going to talk about chapter, let's see if you can see that right there, 5 of my book, Strategic Money Planning, 8 Ways to Get Your Financial House in Order. And this chapter is dedicated to the heretical piece of advice I give people all the time, that it's okay, literally it's okay, to borrow against your 401k or your 403b if you're going to pay down debt. Now, I wish no one had debt. In fact, my book, the very first chapter in this book is called Debt is the Enemy. And in the first 3 chapters, I talk a lot about cash flow and debt management. And the problem is, of course, that everyone has debt. Most people got debt of some sort, be it a mortgage, be it car loan, car lease, credit cards, student loans, you name it. It's just the cost of business of living in America nowadays, and it's too bad. But at the end of the day, how do we use our assets in the most favorable way possible to minimize our liabilities is what we're going to talk about. And I don't think a lot of people pay much mind to the idea of borrowing against the 401k in which to eliminate high expensive debt, and they should. I am a perfect example. I've done it. And initially, I did not do that when I was like, yikes, I don't want to borrow against my 401k. That's my retirement account. But my credit card just kept building and building. I said, this doesn't make any sense. I'm getting a less rate of return on my 401k than I'm paying on my interest on my credit card. On top of that, my 401k is not guaranteed. On top of that, sometimes it goes down in value. That never happened on my credit card. I mean, your credit card, the only way it goes down in value is by paying it more than what the interest is costing you. But if you're paying 10% on your credit card and you're only expecting 6% on your 401k, and that 6% is volatile, it can go up and down. I mean, sometimes you might get 17%, but sometimes you might lose 17%. Doesn't make any sense. So go ahead and borrow from your 401k in which to pay it off. Now let me give you the logistics or the mechanics, I suppose, on what it happens when you borrow from a 401k. All right, so let me get myself out of the way here a little bit. And this is a table I used in the chapter 5 of my book. You should borrow against your 401k to pay down debt. So in this case, we have a guy with $50,000 401k that his rate of return, his expected rate of return is 6%. All right, now he also has $10,000 in credit card at 10%. So similar before, he got a 6% expected rate of return. I can go like this, but that's his thought. They should get 6, and he's paying 10% to the bank and credit card. So what happens? If he borrows $10,000 from his 401k, a couple things happen. One is the interest rate that you pay is contingent on whatever the rates are at that time. When I did this chart, it was August of 2017, and the rate was 4.5. So the interest rate is 4.5. And now what happens is you borrow $10,000 and they're going to run your company, the HR folks are going to run in a 5-year, 60-month amortization schedule. You have 5 years in which to pay that guy back. All right, so you have 60 months, or it might be 120 paychecks. Well, for simplicity, I'm just saying 60 months. So basically, if you run a $10,000 amortization over 5 years at 4.5% interest, your monthly payment is $188. You're going to pay $188 60 times, which means you're going to end up paying back $11,280. You'll pay back $11,280 on the $10,000 you borrowed. Where does that $11,280 end up, though? Because essentially you paid $1,280 in interest. Where does that $1,280 in interest end up? It's in your account. You took out $10,000, and over 5 years you put $11,280 back in there. Now, secondly, the $188 you're putting back in there is also going to get that 6% or whatever it is your expected rate of return. In this case, we're saying 6%. So you took out 10,000 bucks, you paid 11,280 back at $188 a clip. But that is also growing. So at the end of the 5 years, your $10,000 that you took out now is $13,177 in your account. So you took out 10 and you put back 13. Does that make sense? So none of that, other than where I used to work, is a $100 loan fee. That was the only thing that I did not gain. Everything else went back to me. The 4.5%, the percent interest rate, the $188 a month payment, everything I had went back to me. When I had that $10,000 withdrawal or a loan, I should say, the cash came into my banking account and it was not taxed. All right, so I had money coming out, tax-free, had money going back in. Now that was after tax. The payments that you make back on your 401k, you don't get a tax deduction on, but why should you? I mean, the money I took out, I never paid tax on anyway. So I took that $10,000 out. I didn't pay tax on that. I didn't pay tax on it going in. So of course that money going back in to repay that loan is going to be not tax deductible. Who cares? It's a wash. But again, I started with 10,000 bucks. I took out and I ended up putting 13,177 back in. All that money is mine. So the interesting thing is, I got two scenarios here. One, let's just say Joey did not borrow $10,000 from his 401k. He heard all the negative stories of what it's like to borrow from your 401k. He said, I don't want to do that. So instead, he left his credit card at 10%, and he said, I'm just going to leave my money in my account to grow at my expected rate of return of 6% a year. After 5 years, he had roughly $67,000 in that account. He started with $50,000. He ended with 67. That's a simple present value of 50,000, 6% interest rate, 5 years in. If you're looking at a financial calculator, which you should have, which I probably have 5 of these, and his ending value is let's just say $60,000. On the other hand, old Josh said, nah, I'm not going to do that. I'm going to go against the financial planning rules, and I am going to borrow against my 401k. And so now my 401k account balance is down to $40,000. But after putting $188 in every single month for 60 months, plus the 6% expected rate of return, I actually have $67,070. I actually have more in my account than what Joey does. It's that simple. I actually made more money, but it doesn't end there. So let's go down to the next page. It gets even better. So remember, we had $10,000. And Joey said, I don't want to pay that $10,000 from my 401k. I'm just going to pay it back. My $188 I was paying back into my 401k was what his payment was on his credit card, just so we can compare apples to apples. I took $188 a month. I was paying it back to myself in the 401k. Joey was taking $188 a month, and he was paying it back to his credit card. After 5 years, he starts with $10,000. $188 a month for 12 months is $2,256 at 10%. After 1 year, he's got an ending balance of $8,800. But after 5 years, he still owes $1,772. So he didn't even pay it off. So not only is he still upside down on this by making the same payments I was, but he still owes $1,700. But on top of that, I have $159 more in my 401k. All because I used my assets strategically to pay down my liabilities. I mean, there's no getting around this, folks, is that if you can use this strategy, you should. And the simple facts are, the reason being, Joey is paying 10% interest to the bank. It's not compounding. It's not accumulating. I'm paying 4.5% interest to myself. On top of that money going back in is also generating a 6% rate of return. So even though I started at a lower balance, because I'm putting it back into myself with interest and with compounding rates of return, I actually have more money in my account when 5 years are over. But even better is Joey still owes $1,700. I do not. I have no credit card debt whatsoever. Pretty interesting, huh? Now, should you do this for everything? No, and here's why. Let me give you an example. Some people say, well, that makes sense, Josh. You can't borrow from an IRA. Just be advised, you can't. But let's just say you have a 10% credit card and you're only expecting to get 6% return on your IRA. Should you do this strategy there? No, don't do that, because the IRA does not give you the option to borrow. The IRA, you have to take a redemption, which is taxed as ordinary income from the first dollar. And on top of that, if you're 59 and a half or younger, is another 10% penalty on top of that as well. So let's just say you're in the 25% tax bracket. It's going to cost you $13,333 just to borrow or to net $10,000 from your 401k because of taxes. You got to pay taxes. You're not taking a dollar for dollar. You're taking $13,000 out in which to have $10,000 to pay off your credit card. Throw in the 10% penalty on top of that, you're taking $15,000 out to borrow $10,000. So don't do that. That doesn't make any sense. What if you have investment accounts outside of an IRA or 401k? What if you have an account that, let's say you put $5,000 in there, now it's worth $10,000. So you have a $5,000 long-term capital gain. All right, so the $10,000, you're thinking, should I sell my $10,000 investment to pay this $10,000 credit card? Well, the question is, what's your expected rate of return? Again, if it's 6% on the investments, and you know, and that's not guaranteed, and you know for a fact it's 10% on the credit card, you should probably sell the investment to pay off your credit card. And here's why. Because a $5,000 gain is taxed as long-term capital gain, which is only taxed at 15%. It might even be taxed lower depending on your tax bracket. But if we're going to use apples to apples, we have to say you're in a 25% tax bracket, which means that $5,000 capital gain will cost you 15% of that, which will cost you, let me get my trusty calculator. It's going to cost you $750 in taxes in which to sell that $10,000 investment account. So it's going to cost you $750 in which to use that money to pay off a 10% credit card. I still think it absolutely makes sense to do that without question, because two things. One, $750 in taxes in a one-time tax one-time tax payment is a heck of a lot less than $1,000 or $800 or $600 you're going to pay every single year because you're paying 10% a year on interest on a credit card that right now is at $10,000, maybe next year will be $8,000, maybe next year will be $6,000. Either way, you're paying $1,000, $800 in interest, $600 in interest, and so on and so on. So I'm going to pay $750 now to avoid thousands of dollars in interest in the future. Only makes sense. On top of that, let's say we are in a market like we were in 2008, and your account went dropped 50%. Now you only have $5,000 in that account. Now you don't have any taxes if you were to sell it because you lost all your gains. But you only have $5,000, but you still have this $10,000 credit card. So if you could have sold your portfolio, paid $750 and wiped everything out, you're going to be a whole lot better shape because now you have no debt and you have no asset. You have $10,000 is gone, $10,000 of assets are gone. It's a wash. If you have $10,000 of debt and the market falls 50%, now you have $5,000 in assets and $10,000 in liabilities. You have a liability still of $5,000. All right, so to save the $750 gives you the potential to have significant downside on your asset base, all the while your liabilities are fixed. As I said in chapter 1, debt is fixed. Income is variable, and I would even say investment rates of return are variable, but debt is fixed. So if we are pretty certain, and I don't know why you would be, that you're going to make more money on your investment than you will on your debt, then yeah, by all means, keep the debt and just let your investments roll. If you're at 10% and you're pretty certain you're going to make more than that, I'd challenge that, frankly. I don't know how you do that, but hey, that's up to you. At the end of the day, though, 3 scenarios you got to consider. 1, it's okay to borrow against your 401k. To pay off debt, in particular to pay off debt. Now, there's other reasons to borrow against your 401k from a tax perspective to your heirs, and I'll talk about that in a different video. but we're not going to talk about that here. But in terms of paying off debt, it is okay to borrow from your 401k. Absolutely. It is not okay to take a distribution out of an IRA and to pay off interest on a credit card simply because a distribution from an IRA is taxed 100% as ordinary income. And if you're under 59.5, there'll be a 10% penalty tacked onto that as well. It doesn't make any sense to do that. It is a reasonable thought process to sell a portfolio, again, a non-IRA portfolio in a taxable account, pay a long-term capital gain. Long-term capital gain means you held the assets for over a year to pay off a high credit card debt. Absolutely, it makes sense. But again, that will cost you some taxes if you were to do that. So you just got to be prepared to pay the piper there. You can't get around the taxes. But if you don't do that, the markets go against you, as I talk about here in my book. You'll be sorry. You wish you would have done that. So, what are your thoughts? Have you ever considered borrowing against your 401k? Did you ever do it? Oh, before I forget, there are negatives here. If you borrow from your 401k and you leave your company before you've paid that guy off in full, the remaining balance of what you owe, and again, it's a 60-month amortization. So let's just say you borrow $10,000 after a couple of years, you quit the job and you still owe $6,000 on that 401k loan. That will be taxed to you as ordinary income, and if you're under 59.5, that also will be subject to a 10% penalty. So you just got to keep that in mind. If you think you're going to leave your job in a year or two, just remember there is a tax consequence to not paying off the 401k by the time you left your work. All right. Again, it'll be subject to ordinary income on whatever is left of the balance, plus a 10% penalty. Well, that's something to think about for sure. That's the drawback. The other drawback is you just don't know what the rates of return are going to be. I mean, we're using a 6% expected rate of return. What if that $10,000 you borrowed, it turned around and you're up 15% of that money? Well, yeah, that stinks. I mean, there's no other way around that. Potentially, you could be leaving on the money on the table from borrowing against your 401k. You're only giving yourself 4.5% back, where if you would have left that money in there, it could have gone 15%. I never argue that, though, because that's just luck. That's risk. I mean, you don't know if you're going to get 15% the next year. You just don't know. In fact, if anything, we know that the market drops 40% of the time. So every year there's a 40% chance in the market that you're going to lose money. So yeah, you might get 15%. Again, I'd wonder how you're going to do that. But there's even a more significant chance that you're going to lose money for that year anyway, just because of the history of the market there. So I don't think that's a valid argument. But if that's your feeling, hey, more power to you. I'm not going to argue with it. But just remember, borrowing against your 401k is okay. Any comments? What have you been told? What's your experience with borrowing against your 401k? I'd love to hear it. Put it in the comments below. As I've said before now, give me a thumbs up. Thumbs up actually help me promote my content on YouTube and Google so other people can see the content. It turns out the activity that the users or the the consumers, you guys, use, if you comment, if you give me a thumbs up, if you subscribe, all that helps me get my content out there for YouTube and Google to post for other people who might not be aware of the Heritage Wealth Planning YouTube channel. So if you like what I'm talking about, give me a thumbs up. If you don't like what I'm talking about, just pretend we never met. Don't give me a thumbs down. It hurts me. I don't care. Do what you got to do. But if you do have comments, put them in. I would like to see them. And even negative comments are fine. The negative thumbs down I don't like, but a negative comment is fine. I don't care. Put it on there. Any comments actually help me. Always subscribe, that red button, subscribe, so you'll be signed up for further content. And don't forget the bell for notification. So that way you'll receive an email, and the next time you log into YouTube, you'll have a little red thing on your notification bar that says you got new content, and it'll be coming from Old Heritage Wealth Planning. Hey, look forward to the next time we talk, guys. Put your comments below, and we'll see you next time. Thanks.